Afternoon. How are you all doing? Let me just get chat windows open. 1 second. Afternoon, Marco. I think it might just be you and me today. Bit of a weird session today. So yes, this morning Zoom broke basically. There was an SQL error in all of the meetings that were scheduled, all of the recordings, everything. So they had some major problem which got fixed basically. So yeah, apologies for this morning. Couldn't do anything about it because there just was nothing there. Zoom. It was a massive problem. There was loads of people reporting it. I phoned Zoom. I was 114 in the queue, and I decided not to hang on. So they obviously had a massive influx of people moaning at them, which is probably right. But anyway, so today we are on prop week now. So what we're going to be covering is we got the prop trading to actually get paid part of the sort of course, if you like. So these first two videos, how prop firms work and CFDs versus futures, which is best, is designed to explain the business model, explain the way that they work and the differences between the different types of prop firms, so that you can decide really which way to go. The way that you manage risk in both is exactly the same. So this session is really about how to manage risk within the prop environment, because it's very different to when you're trading your own capital, and basically design a risk plan to make sure that you don't blow the accounts as much as you possibly can. So the idea of this lesson is to design a risk plan that passes evaluations and preserves those funded accounts when you get them. There are different ways to achieve the same goal, basically. So we're going to look at different ways to manage risk. There's a very different approach to passing an evaluation and managing a funded account. They often have very different rules. So you need to approach them in a slightly different way. So I'll explain basically how I do it with regards to risk. So the sort of plan elements, as I've called it here, are understanding what you have to play with in reality, using the planner to see what will happen and stick to a plan that uses a positive risk reward. So we're going to use the prop calculator to look at some scenarios of and basically plan out some sort of risk parameters basically for different types of evaluation size-wise. Look at overtrading. That is the number one reason people blow accounts, me included. Overtrading is a problem in prop because you really can't take many trades a day. So you have to try and focus on the A1 setups as much as you can. Passing, in my experience, is all about limiting your daily trades to a small number of trades that have enough wiggle room to work, but also have the potential to give you a big reward back. So we'll look at overtrading and how that kills you. Be aware of daily loss, trailing drawdown, and max exposure. So obviously exposure, we've done a session on it in the 101s, and that is, again, very important in prop. Scaling rules and trade frequency, once you've passed, some prop firms will adjust this, so you need to be aware of that, and it is a good thing, not a bad thing. News and overnight risk rules. Again, this is just something to do with risk within prop firms. You have to be aware of this because you will blow accounts. So the idea of this is you'll come out with a rule set that will survive prop, and a full understanding of what the outcomes will be of using the two different risk profiles, which I'm going to go through. So understanding what you have to play with in reality. This is the first part. We've kind of covered this already, but I'm just going to go over this again because it is incredibly important. And we're going to use this when we do the prop calculator in a minute. So with prop, you have to focus solely on this figure here, your trailing drawdown, your end of day trailing drawdown, your intraday trailing drawdown, your max loss if they run in that way. But whatever it is that they have given you that you cannot surpass, that is what you have to base your risk around. Okay, so Forget these fancy numbers that they show you over here. It's absolutely irrelevant. This 150K has got nothing to do with anything. They are giving you $4,500. That's it. Okay. So your risk needs to be based on this. So imagine yourself depositing 4.5K in your own account. If you are going to risk 1% of your account per trade, what would you be risking? Yeah, that is what we're looking at. Okay. So 4,500. Okay. That is the amount of money you've deposited into your account. If you're going to risk 1% per trade, that's $45. Okay. That is the risk that you as a normal person, and if you are aggressive and risking 2%, you might risk $90 per trade. That is what you would do if you had your own funds and you were going to start trading, okay? Nobody in their right mind risks more than 2%. That's massively aggressive. 1% is aggressive. 0.5%, yeah. But or even under that. But anybody that goes over 2% risk is just asking for trouble. You're going to blow the account at some point because you're going to get that losing run. So this is what we're working with, 4.5K in this case. I'm going to use as an example 100K here, which is $3,000. Okay. So that's what you've got to play with, and that's what you need to focus your risk on. Okay. But you're not going to pass an evaluation if you use 1% risk. Okay. So for example, here on the 100K challenge at FTMO, you have a maximum daily loss of 5,000 in step 2 and 5,000 when you get the account. Okay. The maximum total loss you can take is 10,000. So we're working with this one. It's 5,000. That's what we can risk in a day, basically. Profit target is 10,000, double whatever that risk is. And you see here, we've got 3,000 to play with. We've got to bring back 6. So we've got to double the account, right? So you're not going to double an account by risking 1%. So we're going to go over onto the planner and we're going to look at what you need to do to pass. So let's come over to the prop firm calculator here. And if we use the 100,000 starting balance as an example, okay, and our target is going to be, let's put this in correctly, 6%. Okay, and our maximum loss limit is 3%, 3,000. Okay, and let's say we're going to trade, let's say we'll take 2 trades a day and we're going to do it in 10 days. Okay, and we've got a strike rate of, let's say, 50%, and we're going for a 1.5 hour. Okay, risking 1% per trade. So if you go down and look at this, what we're actually doing is we are potentially losing, risking 1% per trade based on that 100 grand, $1,000 a trade. We've only got 3K to play with, right? When we win, we're going to win nice and big, which is lovely. But when we lose, we're going to lose that. If we are taking 3 trades a day, for example, okay, and you get 3 losers in a row, that is your account blown. Gone, put. That's it. You're out. The end of the story, isn't it, basically? So you cannot risk 1%. So the best thing to do is to play it realistically and say, okay, I've got 3,000 as my starting balance. That's all I've got to play with. Okay. And what they're asking for, I can't actually do it in here, can I? I've just realized, is a target of 6K. I can't actually do it in here. So I'm going to have to do it this way. That's annoying. Because basically what they're asking me to do is to double my account, aren't they? Yeah. So let's stick it with that 6K. Right. But your risk per trade basically cannot be that, because you're just going to keep blowing accounts when you get losing runs. So there's 3,000, 3,000, 3,000. Let's put that trailing limit on. So you're going to constantly hit that little trailing drawdown that comes in. So what you've got to do is risk no more than X% of the 3,000 you've got available. So you've got 3,000 drawdown. So if we reduce this risk down to 0.5% on a 100K account, you're still risking $500 every time you lose a trade. Okay, so you are still going to fail the vast majority of your evaluations, and some of them will still be alive, but you're still going to lose a load and not have passed most. Yeah, so you've got 0 passes there, 2 passes there, 0 passes. So risking 500 is too aggressive. Okay, with this particular risk reward ratio that we're using in a 50% strike rate, you will get there eventually. Okay, but if you up the days maybe to 20, you'll probably find you'll pass more of those. Maybe not. Yeah, there you go. So if you're going to use a high risk, you're going to take a long time to pass these valuations, okay? But that 0.5%, so you've got 6 trades basically. So let's say we lose 6 trades in a row, which is 500 times 6 is $3,000. That's it. You've lost the account and you failed the challenge. But if you get a nice winning run like this here, you're suddenly going to get that account balance up to a decent level, 103,000 in this particular case, but that's still not a pass, is it? We've got to keep trading and trading and trading and trading. So what you need to do is you need to either go 2 routes, okay? So the first route that you can take is to go aggressive. The aggressive risk parameters are risking somewhere between 0.5 to 0.75%. I can't actually get to 0.75% either, but this is how I do it. 0.5% to 0.75%. And I always go with a decent risk reward ratio. Okay. So this is kind of your evaluation risk profile. So what we're looking to do is risk a decent amount of money, 700. So if we get the calculator out again, 3,000 divided by 700. That gives us 4 trades, basically. So in a day, we can take 4 trades. Now, this is really aggressive because most of the prop firms will give you a minimum trading days, which is usually 5. But you'll see that you will pass the vast majority of these with that type of risk parameter. But you do run the risk of blowing quite a lot. This is with a decent strike rate. So most people's strike rates is going to be sitting down here somewhere. But the important thing is that you get that risk reward ratio. It's the most important thing because what we're looking for when we're passing an evaluation is we're looking for that favorable condition in the market where we can get a good number of trades in our favor, a couple of losers, a good number in our favor, a couple of losers. And even if our strike rate is low, with that high risk reward ratio, we will always be recovering very quickly back to where we were when we had drawdown. Yeah. So that gives you that nice sort of equity curve. Okay. So it's important when you're in evaluation that you try and go fairly aggressive. But this is the key. Yeah. If you have an aggressive strategy with even like going with 1.5% with a 1-to-1 risk reward ratio, you're still going to blow the vast majority of your accounts, you see? Yeah, because you're going into aggressive. You can't risk $1,500 on a trade. 2 trades and you're out. That's it, you're dead. But you've still got to be fairly aggressive because we've got to pass these. We've got to get them over the line to get paid. So that is the thing that I always go for. I never take a trade unless I've got a 1-to-2 risk reward ratio, whether it be the opening range breakout strategy, any support resistance bounce plays, inside bar plays. We're going to cover all these when we look at the strategies. But whatever I'm doing, I have to have a 1-to-2 risk reward ratio because I found that that is the only way to realistically get these over the line because you're trying to get them done as quickly as you can while the strategy conditions are meeting the market conditions. If the market conditions are going to be terrible, you want to know about it quickly as well, so you can scrap it and then move on to the next evaluation and get the next one over the line. Okay, so your risk should never be more than, and in this case here, 0.5%. I'm talking sort of trying to say $3,000 basically is $300 worth of risk. Okay, so I'm looking at trading somewhere around 15% of the account balance. Okay, so get my calculator out again. 3,000 times 15% is $450. Okay, so $450. So that's roughly going to be 0.5 to 0.7. Yeah, 0.5 to 0.7. That's where I would look to place my risk of your total starting balance. That way you're going to be able to survive, but you're also going to get a decent amount of these over the line. Okay, so it's a numbers game. That's all prop is. It's a numbers game. We take on X number of evaluations and we need to get X percent over the line. We just want to get some funded. Okay, so that's how you run the evaluations. The evaluations, you must make sure that you're never risking more than, I would say, 15 to 20% per trade. So for example, and obviously this is bearing in mind if we're taking 2/3 trades a day, because what we don't want to do is lose more than $1,000 in a day, ideally. Yeah, on these evaluations, I'm talking the 50, the 100, the 100K sizes. Yeah, so you don't want to lose more than sort of 50% of your total drawdown in one day. We want to be able to survive for 2 days at least. Okay, because what we're looking for here is for day one, the market to not be in our favor. We lose 50% of our drawdown. Yeah. Day two, the market is in our favor. We recoup that 50% and make an extra 25% on top. So that puts us ahead of the game. If on day three, the market's not in our favor, we're going to lose 50% of our available drawdown again. Yeah. And then in day four, the market is in our favor. We get our money back and we make some on top. And what that does is it just puts us ahead all the time of that equity curve. Yeah, but we've got usually with most evaluations somewhere between 5 to 8 days to do this in. Yeah, but if it doesn't work out that way, this method will allow the account to survive for more than that 5 days, and you'll find that you will still be in these evaluations, but you won't have blown the majority of them. Yeah, so you will either quickly pass or you will still be in after the initial 5, 8, or however many days it is. But some of them will be disappearing along the way. We're going to look tomorrow at how to, or rather on Wednesday, at how to spread your risk out to make sure that you don't blow them all in one go or pass them all in one go. Yeah. So we're going to spread that risk out with diversification. When you've passed an evaluation, so that's getting over the line. So risking, go with 0.5, conservative 0.5, aggressive 0.7. You've got to have a strategy with a 40 to 45% strike rate, ideally with that 1 to 2 risk reward ratio. That's not unachievable. Opening range breakout, for example, will be able to achieve that for you. It will lose accounts along the way though. When you've passed your target, okay, and you've got that funded account, I then drop that risk right down to somewhere between 0.3, usually 0.3 is around about where I go. So 0.25, 0.35, something like that of the balance. And what that allows you to do is hold that account. Yeah. So if we bang this up to 30 days, for example, using the same sort of strategy with around about a 45% strike rate, maybe 40, maybe 42 sometimes, but a 1 to 2 risk reward ratio, what you'll find is this says obviously passed because we're trying to pass an evaluation. But what we're interested in is how many times have we failed? How many times have we hit that trailing drawdown limit? Not one. Okay. Yeah. We lost one funded account. We've still got 19 of them. We lost 2. We still got 18. Lost 19. Lost 1. Still got 19. Still got 20. Still got 18. You see? So by dropping that risk down, what we're doing is we're generating alpha. Yeah. We're making a profit. 6,470, 6,400, 6,000. Yeah. So we're still making our money over a period of an entire month. But what we're not doing is running the risk of blowing that account, because now we're only risking 10% of our total available drawdown. Remember, we've got 3 grand's worth of drawdown to play with. We're only risking 10% of it now. So we can survive a losing run of 10 trades and still be in it. Yeah, we got a losing run here. Look, 1, 2, 3, 4, 5, 6, 7 trades in a row there. Yeah, we dropped down, but we recovered the account back up into profit because we've got risk now. We're not interested in hitting a target. We're interested in staying alive to get paid. That's the goal. Yeah. So once you've got funded, what you do is you drop your risk by 50%, little more if you want to. And your goal is basically to trade up the account over a level where you can make a withdrawal. So most of these prop firms just quickly go back to the Academy a minute. Most of these prop firms have rules where you will have scaling rules and trade frequency. Yeah. So when you pass the evaluation, what most of them will want you to do is reduce risk. Okay. So, and this is obviously what we're doing anyway when we get funded. But what they'll often do is go, okay, you remember you had 60 micros that we were allowing you to trade on futures. Okay, you can't do that anymore. Okay, you've got 20 micros now. Not a problem, because we're only going to be trading one or two at a time anyway. But you will have this scaling rule where they will reduce your risk to make it harder for you to hit target. You'll have to trade a certain number of days per month. But the most important thing is they will set you a target from your initial starting balance to reach before they will give you a payment. Now, what we've got to do is get over that, because what most prop firms will want you to do is leave a buffer zone between the starting balance. So let's say this is 100K, yeah, and an initial target of say 2K or 3K or whatever that may be. And then you can have anything above that, but you must not draw it down below the maximum drawdown that we gave you originally in your evaluation. Okay, so in 100K, they're giving you 3K to play with, which is 97 grand. You need to trade it up to 103K, and anything above there, if you draw it out, it always brings you back to 103K, meaning you've got that buffer zone that you will not go below the initial starting balance. Okay, so your goal when you pass is to reduce risk, trade it for 10, 20 days, however many days it takes to get yourself up to a set amount of money, and then you stop trading that account, or you trade one micro every day or 0.01 lot every day to fulfill their rules, and you then take that payment. Okay, so your risk has always got to be proportionate to what your goal is. Your goal in evaluation is hitting a target that they've set, which is doubling that account. Your goal in funded is not to hit a target, it's to survive, to get paid. There will be a 5-day, a 10-day rule in there. If there isn't a minimum number of days traded rule, there will be a minimum balance you have to achieve rule. There is always a rule in there somewhere that says you got to do what you just did pretty much again before we'll give you any cash. Okay, so you've got to adjust that risk down, because the chances of you doing 2 evaluations back to back and passing both of them is going to be a lot lower. Yeah, so if we got that target of 6% and that drawdown of 3%, and we're going in aggressive, for example, yeah, with something along those sorts of lines, yeah, you can see that you're going to fail some. Every time you're going to fail some. So let's say that was your evaluation. The next time we run and we have a bad run, yeah, you fail the account. Yeah, you lose it because you had that lovely run up where the market, let's say we're trading opening range breakout. You had that week where everything just went parabolic and we were like, this is easy. The following week, it went, no, for 3 days on the trot. Yeah, that funded account instantly has vanished, because they're asking you to have a strategy that succeeds for a period of time and sustains that condition in the market meeting the strategy for another period of time. And then they'll pay you. And the next time you do it, you're probably going to blow the account, because the market conditions are never going to stay stable enough for you to keep an equity curve absolutely perfectly stable. Yeah. So this is why we go down to these smaller risk levels once we've been funded. Okay. So we use the planner. You've seen what happens. Positive risk reward has got to be there. I have tried many times with a 1-to-1 risk reward ratio, and a 1 to 1.25, 1 to 1.5, that sort of risk reward. It is very, very difficult, because you've got to have that sustained amount of market condition that matches the strategy that you're trading, whatever that strategy may be. Over trading kills accounts. So limiting your daily trades. I set rules on my accounts, whether they be evaluation or funded, to have a maximum drawdown. So it's always a maximum, absolute maximum, 50% of my available drawdown. So if my available drawdown is 3%, which is 3 grand, yeah, I will always set my daily loss limit to be a 1,500, or if it's a 50k account, I get 2,000, so I set it to 1,000. So the very maximum I ever want to lose on one session, which is one day, is 50% of my total available balance. You're going to get periods where you're going to hit a strategy where it just doesn't work. If it doesn't work, stop trading, because the market conditions for this session, this day, this week, whatever it is, are not right. So stop trading. Yeah. So you've got to protect the capital, protect the account. Tomorrow you can get it back. If you lose $1,000 in one day and you've got 2,000 available to you, tomorrow you can make 1,500 and get that 1,000 back and put yourself ahead. But if you do all 2,000 in one day, if you've got 2,000 drawdown, you're out. You've got to start again from scratch. Don't forget, these prop firms, a lot of them have minimum trading days. The most frustrating thing is you go day 1, day 2, day 3, day 4, day 5, day 6, day 7, blown. Start again. Day 1, you're better off just making sure that you always have a buffer zone available where you can trade tomorrow. Because if it's not right today, tomorrow it will be. So make sure that you limit that risk intraday to at least a maximum of 50% of your total available drawdown. If you want to be more conservative, limit it to a third. So I personally go with half. So I run a lot of 50k evaluations. So I get 2 grand to play with. I always go with $1,000 limit. If I hit $1,000, it liquidates my account and says, come back tomorrow. Yeah. So I can't go any further. Over trading will kill you. If you take 3 trades a day and you want to pass in, let's say, 7 days, let's get our target down to normal levels. Okay. And we're going in with something around about that, fairly aggressive. Let's go with a 45% strike rate on 1.2. Okay. So let's run that batch. 8 failed, 9 in progress, 3 passes. 3 failed, 10 in progress, 7 passes. Yeah. So we're losing 50% of our accounts on occasion. If you run that number up to double, 6 trades a day, you're going to fail a lot more of them. You will also pass a lot more of them, but you will also have a high failure rate. It's boom or bust, basically. If you go with smaller accounts, smaller numbers of trades a day, what you'll see is you've got more that you're in or have passed than failed. So the failed number is always very low with low numbers of trades. So when you overtrade, when you do an awful lot of trading in one day, if you take 10 trades a day, for example, you're always going to run the risk of either passing in one go or failing in one go. It's literally boom, bust, boom, bust. Yeah, you've got to pass. You've got to usually have a minimum number of trading days. Yeah, so keep the number of trades down per day and keep the risk fairly high and take those A+ setups. So for example, if you're trading opening range breakouts, if you limit it to just trading the 15-minute ORBs or the 5-minute ORBs, you can only take 2 trades a day per instrument, maximum. So if you trade 2 instruments, for example, the maximum trades you can take is 4. That's going to limit the amount of exposure that you have per day. If you trade the 5-minute, the 10-minute, the 15 and the 30-minute, you never take 8, but you could easily take 4 trades a day per instrument. That suddenly boosts you up to, if you were trading 3 instruments, 12 trades a day. Suddenly you've got a lot more going through. You will pass a lot of them, but you're going to fail a lot of them as well. So there's a much better way of doing it by keeping that exposure low and keeping the number of trades down. So over trading and revenge trading specifically. Yeah. So the first 2 trades of the day don't work out. So you just go in again, in again, in again. Before you know it, you've hit the level. So if you do this with low numbers and high risk, you're going to find that you can't take more than a couple of trades a day anyway, because you're going to hit those loss targets. So keep that very, very keep the number of trades low, keep the risk fairly high, and just take those high targets, and limit your daily trades and limit your maximum loss. So your daily loss, your trailing drawdowns, max exposure, you're never going to really hit with most trading firms. But also be aware of exposure. We're going to talk tomorrow, or rather on Wednesday, about diversification. Be aware of correlation, S&P 500 and NASDAQ. Yeah, don't trade them both on prop. They both go the same way at the same time most of the time. You're doubling your risk. If you get dodgy opens where you get whipsaws, that's double the amount of losses, okay? You can do it if you want to, but you need to drop that risk down even further, which is going to make it harder to pass the evaluation. So be aware of exposure. But this daily loss and trailing drawdown, try to survive each prop at least for 2 days, if not 3. Yeah. So most of these have got limitations. You've got to be consistent. So minimum of 5 trading days. FTMO, minimum of 4 trading days. So if you get that target that you've got to achieve, that 10,000, you've got to have enough risk on to hit that 10,000 in somewhere between 4 to 8 days, or somewhere between 5 to 10 days. I'm always aiming for 5 with a backup of doing it in 10. But if it goes over 10, there's something wrong with your risk. You've got to be able to get these over the line because you need to get funded. You are going to fail a lot of these, which means you're going to have a high churn rate, which means you've got to get these ones over the line quickly and then protect them. Yeah. So it's all about adjusting that risk and having these 2 profiles: aggressive to pass, conservative to keep. Yeah. Because you only get paid on the conservatives. If you stay aggressive, you can obviously get those over the line very, very quickly, but the rules change dramatically. Yeah. When you pass, and you've got to be aware of that. These scaling rules and the trade frequency rules, and the, for example, in Take Profit Trader, the trailing drawdown changes. So there's always rules that are there to trip you up when you get funded. So with the Take Profit Trader, for example, that is your initial trading condition. Yeah, you have to hit that 106K. Just reduce that down to something more realistic. Yeah, so you've got to hit that 106K. Yeah, so achieve that one there in 2 days. Achieve that one there in 4 days. Didn't achieve that one, failed. Yeah, and this is without a trailing loss. When you pass your evaluation and you get a funded account, this static loss line that appears down here, max loss, suddenly becomes a trailing one. Yeah, this orange line here. So when you get funded, what they do is they change the goalposts. So you've got to be aware of this. You've got to reduce that risk down because they will always tighten that net and squeeze you in. In one rule or another, there will be rules that will squeeze you to try and make you fail once you've got the evaluation over the line. So news and overnight risks. If you're trading CFDs, be aware of obviously overnight gaps. With CFD prop firms, you are going to be trading on standard broker feeds. They are manipulatable at the swap. Yeah. So when you get to midnight, those spreads are going to widen. If you've got stops in place, they are going to take you out. They will use any tool in their toolbox to get those evaluations failed so that you take another one, or to get those funded accounts blown. Okay. So be aware. I do trade CFDs, not as much as I used to anymore, mainly because they are a lot harder to keep those accounts. The advantage of CFD trading is you can swing trade, hold overnight, and hold over news on all of them. The disadvantage is you can trade over news and hold overnight because they will spread you out the same way as any other broker does. So just be aware of that. So what I tend to try and do is have everything flat as much as I possibly can at end of day. If I've got something that's nicely in profit, I may break even it, but I will never try and leave a full risk in place because they will slip that risk further and make you more loss. We've got such a small amount to play with these evaluations. You can't be slipped. You will just get the account taken away. News trading, be very aware of. Take Profit Trader, for example, I have been caught out on this. In the evaluations, you can do what the hell you like. When you get a pro account, which is their first stage funded accounts, you cannot trade over CPI, interest rates, and everything else. Yeah, 1 minute before and 1 minute after. If you accidentally leave a trade running, opening range breakout, perfect example. We start trading at 2:30. Yeah. So if this news comes out at 3 o'clock that you're not allowed to trade through and you've got an ORB running, that's a fail. Instant. Gone. Your funded account is lost. So just be aware of that as well with the news side of things. It's something that has caught me out in the past. They're all different news events for different prop firms. So just be aware of that. Okay. So just to recap, the rule set that survives prop constraints. So the first rule basically is your evaluation should be a fairly high risk, 0.5% to 0.7% per trade. That is very aggressive. That is more conservative, but that is still around about 15% of the total available drawdown that you have. Okay. So just bear that in mind. You're hitting the button with a 0.5 risk thinking I'm safe. You're trading 15% of your available drawdown capital. Yeah, still aggressive. For funded, when you've passed your funded evaluation, you drop it down to 0.25 to 0.35 really is my max. And what you're doing here is you are still trading very, 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 very high risk. The reason that we have to still have high risk, but nowhere near as high as in our evaluation, is we've got to get this account up to the targets they set us in evaluation for the vast majority of prop firms. So if they have a 3K maximum drawdown and a 6K target in evaluation, when you pass, they will want you to trade up to 3K, the maximum drawdown, and go beyond that before you can get paid. So we've still got to use high risk because we've got to get to this point. Otherwise, we don't get any money out of them. And what our goal is to do is whatever we've spent in our evaluations, say we spent 2K in a month on evaluations, our first goal is to withdraw 2K. As soon as we've done that, you have got a risk-free trade, basically. So whatever prop accounts you have funded after you've taken that month's worth of initial money out, you've got that to play with. Yeah. If you want to get aggressive with it, do it. It's not a problem because it's free trade, isn't it? You have got no outlay now. You are literally, the only thing that can happen is you either blow the account, lose it, and start back again at the start of month one, or you get a chance to rally it. I always stay here as long as I can, because when you get a nice winning run like we had with the ORBs last month, for example, you can easily double an account, 50% of it at least. So if you've got a decent 3 to 5K drawdown available to you, you can make 3 to 5K. Okay, so 2 rules for different trading conditions. If you're doing a 3-step evaluation, the same rules for evaluation run for stage 1 and stage 2. And then when you get funded, we take the risk down by 50%. So drop that risk down because we've got to trade our account up slowly to get paid. If you want to be aggressive, obviously it's your choice, it's your option, but I would say only really go with the same aggressive stance that you have in evaluation if you've got 3 or 4 funded accounts over the line in one go. And we'll talk tomorrow, or rather on Wednesday, in the next lesson, about how we run multiple accounts to generate multiple funded accounts in one go. So you should have a full understanding of what the outcomes will be, basically. So again, this is just going back to the prop calculator. The outcomes of this is something you should go and play with as much as you can. Just get a full understanding of what is going to happen with the risk levels that I am using in here and how it's going to affect me passing and failing. So 44% strike rate with a 1 to 2 risk reward ratio, looking to pass in 4 days with 3 trades a day, you're not going to do it. But if you say, I will try and do it in 7 days, you'll hopefully find you'll pass some. Yeah, there we go. So you'll get some of them over the line, but it's still going to be tricky, isn't it? So play around with the figures in here and understand the impact between this specifically and this. Yeah, this is what is going to make it really super easy or super easy to fail. Yeah, so you see this one here. I've obviously got 2 trades a day at 1.6%. You're either going to lose 2 trades and blow the account, or you're going to, wow, that one survived 4 days. Or you're not. Yeah, so you will usually blow it in a day, blow it in 2 days, or you will pass it in a day. That's it. Yeah, so it's like usually it's mostly 1 or 2. So you pass it or you fail it in a day. Occasionally you'll get, and what these ones will be, there you go. It'll be win-loss, 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 win-loss in a lovely perfect ratio. Yeah, most of the time. So you no more than 2 losses in a row. Because if you get 3 losses in a row, well, that one survived. Oh, that's because we had a nice big win to begin with. Look, so we had a $3,000 win, and then we lost $3,000. Then we lost another one. That next trade, if it had been a loser, you're out. Yeah. So make sure you understand the relationship between risk and obviously how we got to play it. Does that all make sense? So that one's done. There we go. All good? Yeah. Excellent. Cool. If you're watching on replay, obviously ask a question button is there. But we're going to look in the next lesson at the way that you can spread your risk and diversify your risk to make sure that you get some of these accounts over the line. So the multi-account approach is what I've been doing for a long time. No, so not a long time, a fair amount of time. I started off in prop trading like everybody else, doing an evaluation, passing it or failing it, doing evaluation, passing it or failing it. And what I found was I was spending weeks passing an evaluation just to lose it within days. And then I'd go back to the beginning. And before you know it, you've spent 3 months trying to get a funded account. Yeah, it's not the way to do it because their edge is way, way, way bigger than our edge. So what you've got to do is play the numbers. Yeah, so imagine walking into a casino and be able to not just go on red and black, but be able to go on red and black and green and the first row, the second row, the third row. Yeah, you're going to get one of those coming in all the time. Yeah, so you've just got to make sure that you spread the risk accordingly so that you win something. Yeah, at this. And it's not a case of winning all of it. You're going to lose good half of it a lot of the time. You can win a lot. You can win all of it a lot of the time as well, but it's rarer. So we're going to look at how to do that. But obviously the risk management rules that I've just gone through there, they will apply to all accounts, but we're also going to look at variations on risk management. So we're going to look at running some aggressive and some conservative as well, so that we've got at least a finger in a pie all the time. Yeah, to make sure that we've constantly got a chance of getting those funded accounts passed. Okay, so that's the next one. So apologies for today. Obviously, it wasn't my fault. I couldn't do anything about it. Zoom went down. So if you are not watching this, which I know 90% of you are, because I can see there's only one person in it, you're all going to be watching this on replay. We will be back on Wednesday morning, obviously, for the next session. So usual time, 9 o'clock Wednesday morning, we will go through that lesson. And yeah, if you've got any questions, ask a question. Otherwise, have a good day, and I will see you next time.